All right, today we're going to talk about how to pay yourself as a sole proprietor. If you are a sole proprietor, or in other words, you are doing business and have not formally incorporated into an LLC, corporation, or a partnership, then you are a sole proprietor, my friend. And guess what? Today's episode is all about you. A lot of people on our channel have been asking for some help with this, so if you are a sole proprietor, go ahead and help me out by liking this video and commenting below as we get this sole proprietor party started. All right, welcome to the channel, everyone. My name is Sherman and I am a licensed CPA here at Life Accounting, where we help you save on taxes and boost profits. And if you've never seen an episode from us before, then go ahead and hit that subscribe button, because I promise you there's not another channel like us that puts out quality content to help you with things like this. So today I'm going to walk you through step by step on how to pay yourself as a sole proprietor. Specifically, I'm going to explain who is a sole proprietor, how sole proprietors pay taxes, and how much you should be paying yourself as a sole proprietor. So if you stick to the end, I'm also going to give you my framework for how sole proprietors should be paid. All right, so what is a sole proprietor? A sole proprietor is simply someone who owns an unincorporated business. So if you earn money and you are not employed and haven't registered as an entity with your state, then you are a sole proprietor. For example, let's say you wake up and decide to cut your neighbor's yard in exchange for money. The moment you get paid, you are technically a sole proprietor. And if you're wondering, is that money taxable? Well, you bet it is. According to the IRS, all income received is considered taxable. So then let's talk about how sole proprietors pay taxes. For tax purposes, sole proprietors are considered what is called disregarded entities. All this means is that you do not have to file a business tax return when you file your taxes. Instead, you will file what is called a Schedule C when you file your personal tax return. This is good news because business tax returns are generally more expensive and have to be filed a little bit earlier. Normally, the deadline for filing a business return is March 15th, and personal deadlines are April 15th. So as a sole proprietor, you get an extra month to file your taxes. But what kind of taxes do you have to pay as a sole proprietor? Well, generally, the main taxes are federal income taxes, state taxes, and the big, fat, ugly 15.3% self-employment tax on your income. By the way, you can limit your self-employment tax exposure by incorporating into an S corporation. But for more information on that, be sure to subscribe and check out our channel because we have a video on that. Now, of course, you pay these taxes on your income, but what's confusing is what exactly is income when you're operating as a sole proprietor. A lot of people I talk to get this wrong, so please allow me to explain. Your income is simply the amount of money your business earns minus all tax-deductible expenses or deductions you can take. Generally, it is your net profits from the business you're operating. But many people get this confused with the money they pay themselves from their business. The reason why this is wrong is because you are not taxed on the money you take out of your sole proprietorship. So if your business earned $100,000 in profits and you did not take a penny out of your business, then guess what? You're gonna have to pay taxes on the full $100,000. Well, then you might think that the money you pay yourself from your business then is tax deductible. So if you paid yourself $50,000 out of the $100,000, then that would mean you should be only taxed on the remaining $50,000, right? Wrong. The money you pay yourself is not tax deductible. You do not subtract the money you pay yourself from your business from the business's income. The reason why is because you are not an employee of the business. Therefore, in the eyes of the IRS, all the money the business makes is yours. You are also not a 1099 contractor in your business. Your customers might issue you a 1099, but that just means you are a vendor of their business. They're just writing you off as an expense to their business. but you are not an expense in your own business. So when you file your taxes, you cannot deduct what you pay yourself. Therefore, the transfers you make between yourself and the business are completely irrelevant for tax purposes. So again, business revenue minus tax deductible expenses equals your taxable income. And then you're going to pay taxes on that taxable income. So that's the tax side of how to pay yourself as a sole proprietor in a nutshell. You earn money, you deduct your expenses, and you're taxed on the rest. Now, the only other tax piece here is that technically you should be paying your estimated taxes on a quarterly basis. So let's say you owed $10,000 in taxes last year. You'd simply divide this amount by 4 and pay $2,500 each quarter to the IRS as your quarterly estimated taxes. As long as you pay 100% of what you paid last year in taxes on a quarterly basis, then you don't have to worry about paying any penalties. Or you can also pay 90% of what you expect your tax liability will be this year. And then if you do that, then you're also safe. But to me, that's a little bit more tedious to keep up with as numbers fluctuate. So I prefer just paying 100% of my tax liability last year on a quarterly basis. However, if you expect to earn much less in this tax year than you did in a prior tax year, then it might make sense to pay 90% of what you think you will owe this year. That way you don't have to put yourself in a position where you're giving the IRS way too much money. So as long as you understand that side of things, then you are pretty much covered on the tax side of a sole proprietorship. All right, now let's discuss how to pay yourself in a sole proprietorship. Here are the steps that you should take. All right, step number 1, operate out of a business bank account. Now this is business 101. You do not want to commingle your business funds with your personal funds. It's going to make bookkeeping and finding tax deductions a nightmare. Furthermore, it can also complicate things if you get audited by the IRS. Somehow, they're going to have to make sense of the things you claimed for tax purposes. And if this is not clear, then you might get into some serious trouble. All right, step 2, transfer money from your business bank account to your personal account. You can write yourself a check, you can wire funds to yourself, or you can just go to the bank and take out cash. But remember, the money you pay yourself is your business. Your taxes are going to be based on the business overall profits, not how much you pay yourself. But wait a minute, does this mean you should take all the business profits to pay yourself? Absolutely not. So let's move on to step number 3. Pay yourself, but don't hurt your business. A lot of sole proprietors make the mistake of paying themselves way too much. Sometimes they don't leave enough money in their business, and then they find themselves going into debt to fund their operations or just going out of business altogether. And a lot of times it's because they're taking too much money out of their business. So here's what you need to do. You need to think about cash like fuel. If you run out of cash, you're on E. The game is over. You want to keep enough fuel in your business so you can make it to where you're trying to go. With that said, here's my framework to make sure this happens. And it doesn't involve creating 7 different bank accounts or some of this other stuff that I'm seeing out here. All right, so rule number 1, leave 3 months of operating expenses in your business. Now, this is your safety net. If you always leave 3 months of operating expenses in your business, then you will be able to stomach any sudden or unexpected expenses that may come up. All right, rule number 2, put aside money to pay your estimated taxes. Your taxes are not optional. So don't be that person at tax time who does not have the money to pay their tax bill because you're driving it or because you spent it all on a fancy vacation. Put yourself on a schedule to pay your estimated taxes quarterly and also leave that amount in your business. Rule number 3, put aside money to reinvest in your business. If your goal is to grow your business, then the chances are that it's probably going to cost you some money to do this, especially when you want to grow your business very quickly. So whether that's upgrading your equipment, hiring employees to help you, or developing some type of software or process, be sure to leave this exact dollar amount in your business bank account. And rule number 4, everyone's favorite rule here, pay yourself everything that is left. Look, if you have money set aside for the first 3 things, then go ahead and rob the bank of everything that is left over. It's your money, you earned it. And most importantly, you can have peace of mind and not worrying about Uncle Sam or your ability to pay your bills on time. But I want to hear from you. What do you think about this? Let me know how you pay yourselves in your sole proprietorship in the comments below. Thanks for watching, everyone, and I will see you in the next episode.